Welcome to StokTok's deep dive into PetroChina Co Ltd. PetroChina is one of the world's largest integrated energy companies, headquartered in China, with operations spanning upstream oil and gas exploration and production, downstream refining and petrochemical manufacturing, and natural gas distribution and sales. The company operates across multiple continents and serves both domestic Chinese energy demand and global markets. As of May 8th, the stock is trading at $1.37. Over the past 52 weeks, PetroChina has traded between a low of 72 cents and a high of $1.59, placing current levels roughly in the middle of that historical range. Let's work through the fundamentals, scene by scene, starting with a quick business overview. PetroChina generates revenue through three main business pillars: upstream exploration and production of crude oil and natural gas, downstream refining, petrochemical processing and product marketing, and natural gas distribution and sales across China and select international markets. The company's competitive position rests on its massive scale, access to low-cost reserves in China and Central Asia, established refining and distribution infrastructure, and long-term contracts with the Chinese government and state enterprises. The primary moat is geographic and regulatory in nature. PetroChina benefits from preferential access to domestic energy markets and government-backed investment in pipeline infrastructure that competitors cannot easily replicate. Looking at the StokTok score, PetroChina scores 37 out of 100, signaling caution. Valuation ranks strongest at 20 out of 20. The company trades cheaply on traditional metrics. Financial health scores 8 out of 20. Profitability scores 5 out of 20. Growth scores 4 out of 20. And smart money positioning scores 0 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? PetroChina trades at a price-to-earnings ratio of 12.3 times trailing 12-month earnings. That is well below both the broader energy sector average and historical market multiples, suggesting cheap valuation on an earnings basis. The forward price-to-earnings multiple, based on estimated earnings for the next 12 months, is even lower at 10.27 times. The PEG ratio, which divides the price-to-earnings multiple by expected earnings growth and accounts for growth prospects, stands at 0.97. A reading below 1.0 suggests the stock may be undervalued relative to its growth trajectory. The enterprise value to EBITDA multiple, that is, total company value divided by earnings before interest, taxes, depreciation and amortization, sits at 11.42 times, also below long-term historical averages for energy companies. Most importantly, our DCF model, a fundamental valuation approach that projects future cash flows and discounts them to present value, suggests PetroChina is trading at a 64.45% discount to intrinsic value. In other words, the market is currently pricing the stock significantly below what our analysis suggests it is worth. The price-to-sales ratio of 0.83 times is also attractive, implying investors are paying less than $1 of market capitalization for every dollar of annual revenue. Turning to the most recent earnings, PetroChina reported revenue of $736.38 billion, though this came in significantly below analyst expectations of $2,847.8 billion. Revenue growth year-over-year was 5.9%. Operating income reached $73.42 billion, and net income totaled $48.33 billion. While the revenue number appears disappointing versus estimates, it is important to note that the estimate itself may reflect different accounting methodologies or scope definitions. The company delivered positive operating and net income in an energy environment that has proven volatile. Taking all valuation signals together, the cheap multiples, the substantial DCF discount, and the price-to-sales ratio, a reasonable fair value range in our view sits between $2.25 and $3 per share. This implies potential upside of approximately 64 to 119% from current levels. Market sentiment around PetroChina leans neutral, with insufficient recent news flow to establish a strong bullish or bearish consensus. The valuation setup in our interpretation looks materially attractive for investors with patience and a long-term horizon. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist that evaluates financial health across profitability, operational efficiency, and leverage. PetroChina scores 5 out of 9, landing in the middle range. This score reflects mixed signals. The company is generating positive earnings and free cash flow, but faces headwinds in asset quality and working capital management. The Altman Z score, a bankruptcy prediction model that weighs profitability, leverage, liquidity, solvency, and activity ratios, lands at 2.84 for PetroChina. This places the company in the gray zone, neither clearly safe nor distressed, but warranting caution. A score below 1.8 signals potential financial stress, while above 3.0 indicates low bankruptcy risk. At 2.84, PetroChina sits uncomfortably in between. On the debt side, the company maintains a cash-to-debt ratio of 0.62, meaning it holds 62 cents in cash for every dollar of debt. This is neither particularly strong nor dangerously weak. The debt-to-equity ratio of 0.27 is conservative, indicating the company uses debt prudently relative to shareholder equity. Interest coverage, operating earnings divided by interest expense, reaches 14.48 times, meaning the company earns $14.48 in operating profit for every dollar of interest owed. This is healthy and signals little near-term risk of debt service problems. The current ratio, measuring short-term liquidity, stands at 1.13, meaning the company has $1.13 in current assets for every dollar of current liabilities due within 1 year. This is marginally above the 1.0 threshold that signals adequate short-term solvency, but leaves limited room for error. In our view, PetroChina's balance sheet is adequate but not fortress-like. The company can service its debt and meet near-term obligations, but carries moderate leverage and limited financial flexibility to weather a severe downturn in energy prices or demand. Next up, profitability. Is this business actually making money efficiently? The most important metric here is return on invested capital, or return on invested capital. This measures how much profit the company generates for every dollar of capital deployed in the business. PetroChina's return on invested capital stands at 7.85%. For context, the cost of capital, the blended rate at which the company borrows and funds itself, typically ranges from 6 to 9% in the energy sector. And return on invested capital of 7.85% is therefore close to break-even on a risk-adjusted basis, meaning the company is generating returns that barely exceed its cost of capital. This suggests limited economic moat and marginal value creation from operations. Working down the income statement, the gross margin, revenue minus direct production costs, divided by revenue, is 22.03%. This reflects the capital-intensive nature of energy production. After paying for extraction, transport, and direct labor, the company retains roughly 22 cents of gross profit per dollar of revenue. Operating margin, which includes gross profit minus operating expenses like administration and research, stands at 8.78%. Net margin, the bottom line percentage after all expenses and taxes, reaches 5.56%. Free cash flow margin, the percentage of revenue converted to cash available after capital expenditures, is only 2.36%. This low free cash flow conversion is a key concern. Despite reporting billions in net income, the company is extracting only 2.36 cents of free cash per dollar of sales. This reflects the massive capital requirements of energy infrastructure and ongoing depreciation of producing assets. In summary, PetroChina is profitable in accounting terms, but the profitability is modest, and the conversion of that profit to free cash that can be returned to shareholders or reinvested is constrained by capital intensity. On to growth. Is this business expanding, and at what rate? Over the trailing 3-year period, PetroChina's revenue contracted by 4%, meaning the company generated less total sales 3 years ago than it does today in absolute terms. This reflects commodity price weakness and lower demand during a period of energy market volatility. Over a longer 5-year horizon, revenue growth turned positive at 7.3%, suggesting that on a normalized basis, the company has managed to grow top line modestly. However, this is materially below typical broader market growth rates and signals limited organic expansion. Book value growth, which measures the increase in shareholder equity over time, came in at 5.1% over 3 years. This modest equity growth reflects that retained earnings and capital appreciation have not significantly enlarged the asset base relative to starting values. The dividend yield, the annual dividend payment divided by stock price, stands at 4.32%. This is notable and attractive for income-focused investors. However, dividend sustainability depends on maintaining cash generation, which, as discussed, is constrained by capital intensity and the modest return on invested capital. The growth profile overall is concerning. The company is neither expanding meaningfully nor contracting, but existing in a slow growth regime with declining headwinds from energy transition and competing renewable sources. An investor in PetroChina would be purchasing primarily for current yield rather than capital appreciation or earnings growth. Now let's talk smart money. What institutional capital is actually doing with this name? PetroChina does not currently appear on holdings lists for any top-tier investment gurus tracked by Dataroma, the institutional portfolio tracking service. This is a red flag. Legendary value investors such as Berkshire Hathaway and other household name long-term equity managers are not holding this stock in size. Insider ownership, the percentage of shares held by company officers and directors, sits at 0.00%, which is extraordinarily low. Management owns essentially none of the company themselves. This misalignment of incentives is problematic. When executives and board members have skin in the game through meaningful personal shareholdings, they have motivation to build long-term shareholder value. Zero insider ownership suggests that those running the business have little personal financial stake in outcomes. Over the trailing 3 months, there have been 0 insider share purchases and 0 insider share sales. Complete inactivity from insiders, combined with 0 personal ownership, sends a weak signal. Typically, when insiders are buying their own company's shares out of personal conviction and cash, it indicates management believes the stock is undervalued or positioned for gains. The absence of such buying activity, despite valuation metrics suggesting the stock trades cheaply, suggests either that management lacks conviction or that they are contractually restricted from trading. The 13F filing activity, the quarterly disclosure of large institutional holdings, shows 0% ownership changes toward buys, further confirming that smart money is not accumulating PetroChina. In institutional investing, one of the most reliable risk management tools is following conviction capital. When top investors are not holding a name and insiders are not buying it despite apparent valuation cheapness, it warrants genuine caution. The smart money positioning here is decidedly negative. And finally, the verdict. Let's bring it all together. On valuation, PetroChina trades at compelling multiples with a significant discount to intrinsic value, making it attractive on a pure price-to-book and price-to-earnings basis. On financial strength, the balance sheet is adequate but carries moderate leverage and sits in the gray zone of bankruptcy risk models, warranting caution. On profitability, the business generates positive earnings, but return on invested capital barely exceeds cost of capital and free cash flow conversion is constrained by capital intensity. On growth, revenue is largely flat, and the company is in a slow or no growth regime with structural headwinds from energy transition. On smart money, 0 top-tier gurus hold the stock and insiders own nothing, signaling lack of institutional conviction. In our view, a fair value range for PetroChina sits between $2.25 and $3 per share, representing upside of approximately 64 to 119% from current levels. The valuation is attractive on a standalone basis, but the lack of institutional support, weak profitability metrics, and structural headwinds in energy demand make this a speculative turnaround bet rather than a core holding. The recent quarterly earnings, while profitable, showed that revenue expectations may be misaligned with market consensus, adding execution risk. Overall, we would characterize PetroChina as a deep value play with meaningful downside risk if energy prices weaken further or if the company's dividend becomes unsustainable. This is not a recommendation to buy or avoid. Everything in this video is our interpretation of publicly available data and not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on PetroChina Co Ltd. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.